You may be interested in buying an investment property if you want to diversify your holdings beyond stocks and bonds. You should know that renting is the true core of real estate investing. Before you take the plunge, do your homework. First, you want to look at what is known as the cap rate. What is a cap rate? The capitalization rate, often just called the cap rate, is the ratio of net operating income, NOI, to property asset value. So, for example, if a property recently sold for $1 million and had an NOI of $100,000, then the cap rate would be $100,000 over $1 million, or 10%. You also need to be aware of differences in financing. In most cases, it is more challenging to procure financing for an investment property than for a primary residence. In particular, insurers do not provide mortgage insurance to investment properties, and as a result, borrowers need to have at least 20% down to secure bank financing for investment properties. You should also know that the Internal Revenue Service, IRS, requires you to report the rent as income, but the agency also allows you to subtract relevant expenses from this amount. The capital gain on an investment property is its selling price minus its purchase price, minus any major improvements. Imagine an investor buys a property for $100,000 and spends $20,000 installing new plumbing. A few years later, he sells the property for $200,000. After subtracting his initial investment in capital repairs, his gain is $80,000. The IRS also taxes capital gains, but you can get around this if you use the gains to buy another property. This is called a 1031 exchange. These are some basics of commercial real estate. Learn more by visiting us today.